for the stock market, generally speaking, there has been this year, Tom. If you look at your comments in the past, you've been right. Things have been generally more bullish. But what about the last few weeks? Do you think that we're set up for a year-end stock rally if interest rates continue to show at least some signs that they're stabilizing on the long end?
Stabilizing would be very good, I think, Dom, for a year-end rally because we're getting through the tax loss selling. I think the data is going to start to lean soft on the jobs, which I think is good because it takes some of the pressure off the Fed having to do higher for longer. And in fact, it could pressure yields lower. And I think sentiment is so negative now that we are in a situation where bad news probably is good news for equity. So I think the setup is good, but this is a really critical week.
What about this notion that we have interest rates maybe stabilizing, and this overall story in the market's about a certain subsection of stocks, the Magnificent Seven, whatever you want to call them, being the engine behind the market? Is the fall in yields or hypothetical fall in yields that much more of a buoyant part for stories in the stock market because of those Magnificent Seven?
Yes. I mean, for a lot of reasons. I mean, the Magnificent Seven, as you're pointing out, really powered the equity returns this year. They kind of took it on the gut during earnings season, but they're still very good secular stories. And if interest rates stabilize or they start to fall, as we know, that actually has a positive influence on PE. So I think it is, again, I think these stocks lead into year end, but they are highly sensitive to what rates are doing.
With rates, Michael, it's also about how they set up for corporate fundamentals. We've talked a little bit about the strength of the U.S. dollar, specifically with regard to the Japanese yen. We've seen some real weakness in certain parts of the currency market versus the U.S. dollar. Rising yields are part of that story. How exactly does that then set up big picture-wise for global economic flows? Is it a situation where the U.S. can continue to maybe help power other parts of the global economy as well? Or is it going to be a headwind for everybody that's not the U.S.?
Yeah, the currency story has been really interesting, Don. Now, we think the dollar rally is just about played out, but it's not necessarily played out against every currency. For instance, the yen is a great example. There was sort of an unusual, somewhat confusing statement out of the Bank of Japan last night. Sort of raised the cap on yields, but not exactly. The yen is weakened. Maybe the authorities intervene, maybe they don't. So I'd probably set that one aside. But if you think about other currencies against the euro, Canadian dollar, pound sterling, et cetera, the dollar's recent strength has been propelled by the U.S. economic data being comparatively better than data overseas. Not great, but better. And we think that's about played out. So probably that last push for the dollar is about done. Unless the Fed really sounds surprisingly hawkish tomorrow, I think the dollar is probably going to sort of hang in to perhaps weaken over the next month or two.
How big of an impact, Michael, is the economic story in the U.S. driven by the interest rate picture right now? Is the Fed maybe perhaps justified in holding off on interest rate hikes in the next couple of meetings to see how things play out? Do you think it's an appropriate path of action?
We think holding off is the right path, Tom. You've had such a big increase in long-term bond yields. We've talked about it. Steve talked about it. It's been front and foremost, very center for a lot of people. So you can't really get past that. We think that's done a lot of work for the Fed. Probably the prudent path is to hold off. But the really tough scenario for the Fed is if it holds off for this meeting, perhaps a couple more, and if inflation sort of sits, doesn't have to increase, but doesn't come down anymore, then what? Then the Fed's in a very tough spot. Does it come back in 6 months and start to hike again? It doesn't want to go down that road. So I'd say tomorrow, December, yes, pause, give it some time to play out, but you can't completely discount the Fed having to come back again.
Tom, there's been a lot talked about with regard to the participation of other stocks outside of the top 10 or 20 market cap ones in the S&P 500. It's been a pretty big divergence starting in the spring of this year. Is it still worrisome at all? Do people just buy index funds tied to the S&P 500 because it is just 10 stocks that drive it? Or is there hope for stock pickers out there? Do we think that value-oriented sectors can participate into year end?
I mean, that's definitely weighing on investors' minds, but there haven't been inflows into equities this year, so I'm not surprised that, the large cap names are the ones leading. If interest rates stabilize and we're getting into a decent seasonal period and stocks start to show some resilience, and if the economic data this week in particular comes in a little soft, I think you're going to see inflows into equities, and that would be the equal weight stocks beginning to get a bid as well.
And Tom, before we let you go, a quick last word to you. Is the American consumer in a good enough position to power the holiday shopping season?
Well, you know, they've been resilient so far. So I'd say it's been a mistake to kind of to write off the consumer. So, you know, but that's important too.
All right, they drive 70% of the U.S. economy. Tom Lee, Michael Schumacher, thank you, gentlemen, both for being here. We appreciate it.
Thank you, Dom.
All right.